Throwing $10,000 into dividend stocks right now might be the biggest financial mistake of your life. Or it could be the exact blueprint you need to build a $200,000 wealth engine. The truth is, the first month's payout tells you absolutely nothing about the massive fortune waiting at the end. In this video, I am going to reveal exactly what a $10,000 dividend portfolio pays you month after month. But the final number this tiny monthly income turns into will genuinely shock you. Let's stop playing the stressful game of watching stock prices go up and down every single day. If you want to build real wealth, you have to completely change how you look at investing. With dividend stocks, the only question that matters is how much the company pays you just for holding its shares. You are literally getting paid to do nothing. But there is a secret move that turns this small trickle of income into a raging river of cash. You must automatically reinvest every single dividend you receive. Every dollar that lands in your account buys you more shares of that exact same company. Those new shares then pay their own dividends, which then buy even more shares. It starts painfully slow. A few dollars here, a few dollars there. But give this self-feeding engine enough time, and it will do all the heavy lifting for you. However, an income stream is only valuable if it actually keeps showing up. This brings us to the biggest trap that destroys beginner investors. They hunt for massive yields of 8 or 9% and think they have found free money. Let me give you a harsh reality check. A massive yield is usually a glaring red warning label. It often means the company is bleeding cash and that dividend is about to get slashed. So, how do you instantly spot a safe dividend versus a dangerous trap? You stop guessing and you start pressure testing every single stock. I ran all 10 of our portfolio stocks through an intense screening process. Let's look at Verizon as our first major example. Verizon currently pays a massive yield of around 6.5%. Based on what I just told you, your gut should be screaming that this is a trap. But we do not rely on gut feelings when real money is on the line. We run 6 different safety checks on that dividend. Is the yield strong, stable, and consistently growing? Is the payout safely covered by the company's actual earnings and cash flow? Verizon passes all 6 of these checks with flying colors. It turns out that this high yield everyone is terrified of is actually incredibly safe. Now, let's flip the script and look at a completely different beast like Exxon. At first glance, Exxon's dividend does not appear to be fully covered by its free cash flow. Novice investors would panic and immediately sell their shares. But that red flag is just a starting point for deeper investigation. The truth is, Exxon has raised its dividend for 43 consecutive years. Through oil crashes, global pandemics, and endless economic chaos, they kept paying. A company does not pull off a 43-year streak by accident. They are heavily investing in future drilling, which temporarily impacts cash flow. You have to read the whole financial picture, not just the scary headlines. Once you learn how to filter out the junk, you can build a truly bulletproof portfolio. I constructed this $10,000 portfolio using 3 distinct layers of safety. Layer 1 consists of the boring, absolute bulletproof companies. These are businesses that pay you regardless of whether the economy is booming or crashing. Procter & Gamble has aggressively raised its dividend for 70 straight years. PepsiCo has faithfully rewarded its shareholders for 54 years. Then we have utility giants like NextEra Energy and Black Hills. Almost nobody talks about Black Hills, yet they have raised payouts for 56 years. These 4 unshakable companies form the rock-solid anchor of our income stream. Layer 2 is where we inject the heavy blue-chip muscle. We add Exxon for energy dominance and Lowe's to capture American home renovations. We also bring in Lockheed Martin, a defense giant effectively backed by government contracts. Add Johnson & Johnson with 63 years of growth, and the foundation is set. Finally, Layer 3 introduces the high-powered growth kickers. Goldman Sachs offers a smaller starting yield but hikes its payout incredibly fast. And Verizon sits quietly at the top, doing the heavy lifting for our immediate cash flow. 10 elite companies across 8 different sectors, all working tirelessly for you. So, what happens when we equally split $10,000 across this portfolio today? What does this carefully crafted machine actually pay you right now? When we crunch the numbers, the total estimated dividend sits at $322 a year. That breaks down to roughly $27 every single month. Let's be brutally honest for a second. $27 a month barely covers a basic phone bill. If you click this video looking for a get-rich-quick scheme, you are in the wrong place. But this tiny $27 payment is just the seed. It is not the massive tree that will eventually provide you with endless shade. Over 2/3 of this income comes from the highest quality, safest payers on the market. We intentionally threw out all the dangerous, high-yield junk to protect your capital. These specific companies are raising their payouts by nearly 8% every single year. They are barely using 62% of their earnings to fund these payments. This means they have massive room to keep increasing your paycheck forever. Better yet, this entire portfolio is currently trading at a massive 35% discount. You are buying high-quality, cash-flowing assets for pennies on the dollar. And because we spread the money across 8 sectors, your risk is beautifully diversified. If one sector of the economy crashes, your income stream will not collapse with it. The payments will roll in month after month, like clockwork. In quiet months, you might receive $30. In heavy payout months, 7 different companies might deposit cash simultaneously. You will never have to guess when your money is arriving. But here is the ultimate question that changes everything. What happens if you completely ignore this portfolio and let it run for 30 years? Let's project the sheer terrifying power of compound interest. After year 1, the account balances out at roughly $11,000. By year 10, it quietly grows to over $26,000. By year 20, the snowball is rolling incredibly fast and breaks $72,000. Those reinvested dividends are now buying massive chunks of new stock every quarter. And then we hit year 30. That initial $10,000 investment explodes into a staggering $200,000. But the most impressive part is the actual passive income it generates. Remember that pathetic $27 a month we started with? By year 30, this exact same portfolio is paying you over $636 every single month. That is more than $7,500 a year of pure, hands-free income, all generated from a single, isolated $10,000 decision made 3 decades ago. This is the undisputed power of long-term dividend growth investing. But what if you don't even have $10,000 to start with today? What if you can only afford to invest a measly $25 a week? Click the video on your screen right now to see how that tiny amount turns into $700,000.